What's the latest tax proposals to help fund the Build Back Better proposals and agenda? It's a wealth tax, but it's not a wealth tax. What is it? I'll explain coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. All right, it's not a wealth tax, but blah, 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 explains it, which is basically a wealth tax, okay? Janet Yellen was being interviewed about the latest proposal to help fund, through taxes, some of the Build Back Better proposal and agenda there. The original $3.5 trillion spending plan that included a slew of tax increases, including increase on corporate tax rates, increase on the highest tax bracket, increase on capital gains rates, and various other things. It hasn't gone anywhere. They're struggling with those tax proposals, and Republicans are holding a hard line there. And so they're coming up with new ideas. And the latest idea that's being kicked around is a wealth tax. And when called on the carpet, Janet Yellen, hey, is this thing a wealth tax? And she just stammers and it's not a wealth tax, and then explains what it is, which is a wealth tax.
Well, I think what's under consideration is a proposal that Senator Wyden and the Senate Finance Committee have been looking at that would impose a tax on unrealized capital gains on liquid assets held by extremely wealthy individuals, billionaires. I wouldn't call that a wealth tax, but it would help get at capital gains, which are an extraordinarily large part of the incomes of the wealthiest individuals. And right now, escape taxation until they're realized, and often they're unrealized, and at death benefit from so-called step-up of basis. So it's not a wealth tax, but a tax on unrealized capital gains of exceptionally wealthy individuals.
Okay, so what is a wealth tax? Do I agree with her spin? No, I don't, actually. I totally don't. That's a wealth tax. Now, other countries do have a more pure form of a wealth tax, and that is every year as you're completing your tax return, that's showing the amount of income that you've received, but you also need to report the amount of assets that you have. And there is a taxation. Some countries assess a taxation on the growth of your net worth, the growth of your assets from one year to the next. Now, I would call that would be a pure form of wealth tax. But to me, targeting what this proposal, I'll explain it here in a minute, what this proposal is doing is, hey, if your wealth is above a certain level, we're going to tax you. We're actually going to force. It's not something you would need to do. It's just, listen, if your net worth is this or above, or you have had this level of income each year over the past 3 years, we're calling you wealthy, and we're going to add a tax. To me, that's a wealth tax. Janet Yellen, I'm sorry. Good job trying to spin it. But to me, that's a wealth tax. This proposal targets capital gains, unrealized capital gains. So for those of you that aren't as familiar, this is how that works. If you make an investment, you put money into an investment account, and let's say you buy a mutual fund, you buy an exchange traded fund, you buy a stock at, let's say, $50, and it grows to $150. Do you have to pay tax on that growth? No, it's unrealized. The growth is there, but you don't have to realize that income, that gain, until you sell it. And the question is, well, just because it went from $50 to $150 doesn't mean that it can't go back from $150 down to $50 or even lower, right? Unrealized gains, it's just that. It's a gain, but it's on paper only. It hasn't been realized yet, okay? And so within tax-sheltered accounts like your IRA, your 401k, your Roth IRA, your 529 plan, your HSA that you're investing, whatever, inside those tax shelters doesn't matter. That doesn't matter, because when you sell an investment then and buy another one, you don't have to realize that capital gain, because that's sheltered within that tax sheltered account. That's one of the reasons why we love them. And one of the primary roles of your certified financial planner is to figure out which tax shelters you should be using to fund your financial goals. What is your strategy for tax shelters? But I digress. Outside of tax shelters, so an individual investment account, a joint investment account, a revocable living trust account, something like that. When you buy an investment, that could be a mutual fund, that could be a stock, that could be a exchange traded fund, that could even be a bond, although those don't appreciate as much. But if you buy it here and it's worth this, there's no tax on it until you sell it. Those are unrealized gains. When you then sell it, if you say, well, geez, now it seems like a good time to get out of Bitcoin or whatever it is, get out of, although that's a whole different thing because that's a currency. I just opened a can of worms. Okay, seems like a good time to get out of Apple stock or whatever. Okay, when you sell up here, that's when, if it's, you bought it at you bought it 50, and what's Apple at? Like what, 250, 225, something like that. And you sell it up here. Now when you sell it, you've got to report that capital gain on your tax return. If you've only held that investment for less than 12 months, then that's short-term capital gains and taxed at short-term capital gains rates, which are your tax bracket, okay? If you've held that for 12 months or longer, that investment for 12 months or longer, then it lands on your tax return as a long-term capital gain that is taxed at either 0%, 15%, or higher potentially, depending on what tax bracket and tax situation you are in. That's a great spot for some tax planning. And then the other crux of this is, well, what if that investment that you bought is the S&P 500 index and you never really intend to sell it or sell all of it, you want to hold it to the moon. And so you bought it here and it's grown, it drops, it drops, it grows. And then say when you pass away from the screen, you bought it here and it's worth this when you pass away, okay? Right now, there's something called a step up in basis. So when your spouse or your beneficiaries receive this money, do they then have to report this as gain? No, the current tax law says, well, even though you bought it here and it's worth this, now your beneficiaries receive it and there's no gain there. They receive it at a basis of the date of your death. The wealthy individuals obviously are aware of this and they use it to their advantage. You should as well, to the extent it makes sense in your overall financial situation. But this wealth tax, this billionaire tax, whatever you want to call it, is taking aim at that. Basically, if you have a net worth of $1 billion or more, or have had annual income that you've reported on your tax return of $100 million or more over the past 3 years, then voila, you would be subject to this tax. Now, what is that tax? They're going to make you pay tax on your unrealized capital gains. Now, guys, the details might be out there. I have not seen them. If they force you, so you don't need to, basically what I'm saying is, in that example, the sophisticated example where I use my hands to illustrate what's happening, you buy an investment down here, it's worth this, you haven't sold it. When you sell it, you have to pay the tax on that gain. But if you haven't sold it, there's no tax. Basically, for those unlucky eligible individuals that are super wealthy, you don't have to sell it. They're going to tax you on that unrealized gain immediately. So I have not seen, well then, do they tax you on that and that all of a sudden brings your basis up? Do they tax you on half of that? I haven't seen any of those details, but it's being proposed. If this thing gets traction, I'll dig into those details. You might know them. I'll dig in. We'll certainly talk about it here. But at least for right now, they're looking at those super wealthy and applying a tax on the unrealized capital gains for publicly traded investments, and they're even talking about how we could do this for privately held investments as well. Am I a fan? To me, I'm not a big fan of changing the rules partway through the game. And so to me, even though you could argue someone with $1 billion net worth or higher, or income of $100 million or a year over the past 3 years, you would say, well, they could certainly afford to pay more tax. That's sort of been the argument. Warren Buffett says, yeah, I could pay more tax. My issue is there's nothing stopping you. If that is how you feel, you can just donate money to the IRS. You don't need to create this tax system. You're not forced to work all these loopholes to try to pay as little as tax as possible. If you can afford to pay more and you want to pay more, make a donation to the government. Pay more in taxes. So to me, if the laws are set up where it's, all right, you don't realize a capital gain and pay tax on it until you sell it, I don't love the idea of them saying, you know what, we're going to change that rule for this group. I'm not a big fan, even though I struggle with the deficit and the debt, and I struggle with the gap that's widening between those financially who have been successful and those that haven't been successful yet. I struggle with all of those things. I don't love the idea of changing the game along the way. I also don't love the idea of creating a penalty on investment, especially lucrative or profitable investment. To me, I think that's a dangerous thing. I've shared before, I feel like taxes are sort of like a speed bump or maybe a speed limit or something. There's sort of a slow down here. Hey, not too much. And I don't want to do that with investment. We want to encourage people to be seeking and achieving rewarding investments. We want to encourage people to make investments and encourage especially those that work, that end up working well. Everyone wins. I do get it that there's so much unrealized capital gains, and based on the current rules with step-up basis, it's possible there's a lot of tax dollars that will go unpaid because of that. But to me, I struggle with the idea of slapping the wrist or adding a speed limit or a speed bump or something like that to profitable investments. We want to encourage those, not limit or restrict or penalize those. And then lastly, again, I go back to just if you think you should be paying more tax, then just go ahead and do that. Because you can look all throughout history. Some of the greatest civilizations struggled when the tax burden got too much. Are we there? No, guys. No. This is a low tax rate environment. However, with the amount of debt, with the deficit that we're building and all of that, and some of the proposals of raising taxes, I just do struggle with the idea of raising taxes as opposed to looking at some other ways to manage the finances better of our country. So, all right, I'll get off my soapbox. For you, will this impact you if it is passed? I'm assuming not. The average person doesn't have $1 billion net worth or higher or $100 million of income each year. But doesn't mean you shouldn't be taking some proactive measures in your financial life just in case something like this is passed. Because to me, why did they come up with $1 billion? It could have been $1 million. It could have been a much smaller amount if you have a net worth of $1 million or more. I mean, when you're just making stuff up, you could make up whatever you want. And so to me, use tax shelters. Use tax shelters. Make sure you've got a strategy for optimizing your tax shelters as part of your overall financial plan. In order to do that, you're going to need a certified financial planner who understands taxes or is collaborating with your CPA. Together, they can build a strategy or present multiple strategies that then you evaluate with your CFP to say which ones of these make sense and which ones should we pass on. That's the job you should be working on with your CFP. If you don't have a CFP, you can contact one on my team. Find us online. Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well. Or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.